Welcome back, subscribers, to my world of stocks. We've got another big portfolio update for you today. This time, we're going to be looking at one of the absolute largest hedge funds in the entire world, in Bridgewater Associates, which was, of course, founded by one of the most popular individual investors too, in Ray Dalio, who continues to serve as their senior investor, also overseeing their investment committee, basically guiding all of their biggest investment decisions. And this past quarter, they actually went out and bought very heavily into some huge stocks. In fact, I've got 5 of the largest pulled up right here, and they were increases of 150%, over 500%, over 500%, over 600%, and another 600% too. Altogether, totaling over $1 billion spent just on those 5 stocks, just in a single quarter alone. So massive purchases here by Ray Dalio and Bridgewater. I'm going to run through all 5 of them and share with you my own opinion on each one of them, and I'll even rank them from best to worst too, based on that opinion. So smash that like button if you enjoy these portfolio updates. They're really fun to make for you guys. I enjoy doing it, and we get to look at some different stocks out there in the market. I just really like being able to show you all of that variety. So I hope you're enjoying them too. But with that said, let's just go ahead and jump straight into this list here, sorted by percentage increase. And first up here, we have Johnson & Johnson, ticker symbol J&J, at a whopping 667% increase to their position last quarter, totaling more than $300 million worth of a purchase. Now, you may notice there, though, on that ownership history tab, that Ray had previously been gradually selling out of the position before deciding to buy much heavier this last quarter. And while I can't say definitively why he would do that, my suspicion is that ever since J&J spun out their consumer health business into a new company called Kenvue, which took some of their most iconic brands with them, like Band-Aid, Johnson's, Aveeno, Tylenol, Benadryl, Listerine, and more. Well, I just think investors started to see J&J as maybe not as attractive of a total package as it once was. However, more recently, the company has actually proven to be much more streamlined post-spinoff, being laser focused on their higher growth businesses like prescription drugs and medical devices and technologies, really becoming much more of a biotech type of company than the more traditional kind of consumer staples one of the past, which did, to be fair, generate large, reliable sales for them, but it was also pretty low growth, sometimes even in decline of a business. But last quarter, for example, sales actually grew by almost 6%, while EPS saw a major rebound of closer to 20%. Not bad for a medicine business that just crossed a $15 billion milestone, with medtech sales quickly approaching another $9 billion as well. And 13 of their medicine brands are also growing by even larger rates in the double digits. And that strong performance really helped lift the stock back up this year by over 20%, which is pretty good gains. And despite it trading near a record high, it's actually been suppressed, though, I would say, for that stock price. It's been suppressed for years because of numerous short-term issues, including several lawsuits, causing the stock to only be up less than 100% in the past decade, and resulting too in an even cheaper valuation than the sector on both forward PE and PEG ratios, despite this being, one of the most iconic kind of companies and stocks really in the market to own. On top of which, by the way, goes right along with this, the dividend yield also climbed to about 3%, but it's got a great payout ratio and over 6 decades of consecutive growth, even after the Kenvue spinoff. So J&J has really been kind of a staple in a lot of people's dividend portfolios over the decades too. In other words, this is a pretty attractive business that we've got going on here, and a stock price to go along with it that seems to finally be heading in the right direction, which I'm guessing Ray is now realizing on it, and that's why he's buying it up, again, for those new reasons. So even though I don't own this stock myself, I agree with the move here, and I think he'll ultimately have success with it if he chooses to hold long term. Because of that, I'm going to rank it pretty high here. I'm going to put it at number 2 until we see what else is on this list. And by the way, if you are curious as to why I don't own this stock myself, it's nothing against J&J. It's really just because I already have so much exposure to a lot of biotechs in my portfolio and even medical devices too, all of which those stocks have bigger dividends, cheaper valuations. I like them a lot more. And so I feel like adding J&J too would just be overkill to myself, having too much exposure to that. But hey, for a big investor like Bridgewater that can just hold as many stocks as they really want, I think it does make perfect sense. With that said, though, stock number 2 is actually one that I do own myself as well, and I think that it's one that Ray this past quarter just really went kind of crazy on, buying a giant amount of it, increasing his stake by a massive 644%. And I'm happy to see that because it's a stock, again, that I own too. But that was in the tech stock Cisco, ticker symbol CSCO, which he added over $100 million more of in the quarter. And yeah, like I said, this is another one that I strongly like here, even at today's higher prices where it's climbed by over 17% this year, because I really feel that it's climbed for good reason. As the company has really done a fantastic job of transitioning from their low growth kind of legacy business, it's primarily a hardware seller of things like routers and switches, to now selling all kinds of software services too that are not only higher growth, but are also much higher margin, making the company even more attractive for a future of added, software-like margins to their already, pretty strong business. And this includes, of course, artificial intelligence, cloud, cybersecurity, and more. By the way, all of which are benefiting greatly from one of my most favorite acquisitions that I've seen in recent history of a company that is called Splunk, which was already a very attractive stock on its own. I really liked it prior to the acquisition. And so now being combined with Cisco, it's only made the larger entity even more attractive to me. And yet because of that lower growth kind of legacy business of the past, well, Cisco stock has also been, fairly suppressed throughout history too, very similar to J&J in that regard, also resulting in a much cheaper valuation than the sector, with also a pretty good dividend, around 2.4% yield, but a very low payout ratio and, double-digit growth history. It's pretty good. And while J&J may be more attractive to certain types of investors, especially those focusing on valuation and dividend metrics, I'm personally more excited about Cisco's business and their future potential, especially after the Splunk acquisition. So I'm still going to rank them higher. I'm going to put it in J&J's place at number 2, and I'll just push J&J down one spot so that I can fit it all in there. Okay, coming in at purchase number 3, though, we actually have another very interesting pickup here. And it was another huge increase, too. It was in Uber Technologies, ticker symbol Uber, which they increased their position on by over 500% at over $260 million more added during the quarter. Now, when it comes to Uber, though, I have to be honest with you guys, I was never a huge fan of this one simply because I felt like they just weren't really diversified enough as a business, relying almost exclusively on just a simple ride-hailing service alone, which, although being the most popular among peers, it is a market there that they operate in that I just don't see a huge barrier to entry on. And more importantly, it's also a market that is being heavily targeted by some of the biggest tech giants in the world like Google, Tesla, Amazon, Baidu, and more, all of which, by the way, are also much more diversified into many other markets too, ensuring that they can survive as a company regardless of what happens to their autonomous driving business. Maybe not as much, with Tesla, but for sure that's going to be the case with like Google, Amazon, and others. Plus, I already own each of those stocks too, so I just see almost zero reason to buy this one as well. I feel like it's a stock that I just have like no need for myself. However, I will say that at least so far, Uber has mostly proven me wrong in that the stock has actually performed very well, soaring by over 50% just this year and more than doubling since IPO in 2019 to new record highs. So really proving all the naysayers wrong there. And they're also consistently putting up double-digit revenue growth on positive EPS now too, which should be getting further support, by the way, from new tax exemptions in the new Trump bill that Bank of America estimates, by the way, will save drivers collectively around $1 billion per year. That's not only going to lift Uber's take rate, but it's also going to raise driver demand and retention for Uber's employee base as well, or at least that's the expectation. Now, the result being, though, that, when you look at the growth that they've been seeing, their PEG ratio, price to earnings to growth ratio, is actually pretty good because of that growth. It's sitting at only around 1.3, which is also significantly cheaper than the sector median. But again, I just see too much long-term disruption in this market without enough diversification to protect themselves from it, especially with autonomous driving and AI that can, take over those jobs. Now, that might be a benefit to a company like Uber, but I would argue that Uber doesn't really have a whole lot of experience in autonomous driving and AI, and they've mostly just relied on, in recent years, and I think that's going to continue to be the case, on third-party partnerships for much of that. So even there, I would still rather go with companies like Google and Tesla, and Amazon, who have a lot of that technology in-house. I just see them performing better long-term. So anyway, in terms of ranking it here, again, I acknowledge that they've proven me wrong so far. Not sure that'll be the case long-term. We'll see. But I'm going to put the stock in last place because, again, it's a stock that I don't really want to own myself. All right, we are now down, though, to the final two purchases of the list. And coming in at number 4 is the music streaming giant Spotify, ticker symbol SPOT, which Ray increased his position on by almost 500% too. What was another massive pickup here during the quarter. And what is kind of funny, though, about these, look, I'm going to put it this way. The first two stocks that we had on this list, I saw a lot of similarities with J&J and Cisco in terms of them being, kind of value dividend stocks that also just kind of look pretty attractive to me overall. But now we have these next two stocks in Uber and Spotify, and I'm seeing some similarities with these ones as well, but in a different sense, in that I don't feel that their businesses are diversified enough with also huge tech giants to compete with. And yet both of those stocks have actually proven me wrong in the short term and have performed very well. And I'll just kind of break this down for you. But in the case of Spotify, their stock is also up over 50% this year and over 300% since going public in 2018. But while they are the clear market leader of music streaming with also a growing video podcasting segment too, that market is still highly saturated with some of the absolute worst companies that you would ever want to compete with, including Apple, Google, Amazon, and more. And although Spot's been putting up some excellent financials, the valuation is significantly more expensive than the sector on both profits and even sales. Funny enough, though, I did actually used to own some Spotify stock myself, but I ended up selling it for a profit once it took off, as I just didn't really see too much future potential with them long term. So it was really more of like a swing trade for me, which is very rare for me to do something like that, but it does happen on a rare kind of occasion. Regardless, though, again, long term, I'd much rather own competing stocks like Google and Amazon, just like in the case of Uber as well. And in terms of ranking them, honestly, I have no idea who to put higher here. I have zero interest in owning either one of these, but I guess I'll give Uber the slight edge because of the cheaper valuation, so I'll put them higher by default. But again, it's two stocks that I wouldn't want to own myself long term. Again, even though I keep getting proven wrong about them. All right, guys, that's going to leave us now, though, with the fifth and final purchase of the list. This one, I'll tell you, is actually one of my absolute favorites. It's one of my largest holdings, too. And that is in the chips and AI giant NVIDIA, ticker symbol NVDA, which Ray wisely more than doubled his position on during the quarter, buying up over $500 million more in the stock. And yeah, what's not to love about NVIDIA? I mean, I guess you could argue that it's an expensive stock, given that it's literally holding right now the largest market cap of any stock in the entire world at over $4 trillion after having climbed by over 1,000% in just the past 5 years alone. But when you actually dig deeper into the numbers, I think you'll find that they're putting up such incredible growth that the high price tag is actually worth it in terms of what you get back in return. Over the past 5 years, for example, their data center revenue more than doubled on average per year, with where their GPUs now hold #1 market share in AI training and inference. They're used by all major cloud providers in the world, including more than 40,000 companies and over 75% of the world's top 500 supercomputers too. But the crazy thing is that we're really only just kind of getting started here. In fact, over the next few years, data center capex should easily double in size to more than $1 trillion run rate being spent every year. And I actually think that's a conservative estimate when you consider how intense competition will be, with all these tech companies really competing to be leaders in AI, where they'll have to order millions of new GPUs from NVIDIA just to stay competitive. And some analysts value the market at many trillions of dollars. Morgan Stanley even thinks that AI in total will be worth a mind-blowing 40 trillion. So we can't even really comprehend yet how large all of this could become over time, let alone where new technologies may push it even further too, like is the case with what I think quantum computing could be in the future. So much potential with that. And we know, of course, NVIDIA is already hard at work for quantum computing chips and services too. Anyway, the point being that all of this is leading to a ton of growth for NVIDIA, and not just in sales, by the way, but more importantly in profits, where free cash flow has now soared by a gigantic 13 times over the past 5 years, which they're now using to not only reinvest in the company, but also to even buy back their own stock, buying a whopping $10 billion last quarter alone, and already approving another $60 billion of future purchases too. So even though you might think that the stock is super rich and untouchable at these higher levels, NVIDIA surely doesn't, and they've been buying back their own stock. And I really think that part of the reason why is just because of that insane growth that, believe it or not, it actually results in a PEG ratio that is more than 30% cheaper than the sector median. I mean, that's just crazy to think about, that the world's largest market cap company is actually trading cheaper than the sector still by price to earnings because of their insane growth. We'll see how all of this plays out long term. But again, I'm a big believer in NVIDIA. I'm holding the stock, so I'm going to rank them #1 above everything else on this list. But hey, there you have it, guys. These are my rankings. I got to say, overall, actually like these pickups here by Ray Dalio. Might not be a huge fan of the bottom two, but for sure the top three I do like and agree with. So let me know if you agree with them too, or if you would make any changes to my rankings. I'd love to hear your thoughts about that as well. But either way, I hope that you enjoyed the video. I hope that you're all doing well out there, and I will catch you in the next one. All right, take care, my friends. Bye-bye.